All right, so this is going to be a very quick one. Let's talk about stop loss. So one thing that most people do. I've been talking about stop loss for a long time, especially those of you on Twitter. Like, so for instance, I want to sell AUD card, right, at this current price here, right? What most people would do is because they are selling AUD card here, they want to put stop here, which is good. But ideally, looking at the current structure here, selling AUD card here and putting your stop loss here is risky because looking at the market structure here, any high that you see is a potential liquidity, especially if it is not the extreme high of the market. What this means is that the market can go to this region and take out that level, which means AUD card can take out this liquidity and still sell, right? So in this scenario, if you are looking to sell this AUD card, I'm using AUD card because it's a trade I've identified and I'm looking to sell. So what you are looking at in this situation is if you put your trade here, your stop should not be the next high, but your stop should be the ultimate high. In this situation, it will be this area here, right? So when the stop is here, what it means is that price could potentially take out this high here and your trade will still be protected. And your target would be dependent on your strategy. So when you do this, that is when you decide as a trader to see if this is a good risk reward ratio for you. So what I'll do in this scenario, if I'm looking for a target on this trade, is to measure the last impulse move and then move this last impulse move to the beginning of the next impulse move. And this would be my next target. So this trade is what? A 2.24 risk reward ratio. So you ask yourself whether this is a trade that you're looking to take and it's a good risk for you before you go into the market. Don't do this and then put your stop loss here and go for a 1:4 risk reward ratio. You want a 1:4 risk reward ratio. That is good. Like you could, price can drop from here and you get a 4 RRR on your trade. But most of the time, you are most likely going to be taken out if there is some volatility that comes into the market. Because if you're looking at this on a higher time frame, right, this doesn't look like that kind of scenario, but because this level has already been tested, but there are multiple reasons, and I'll show you an example of a chart which I took yesterday, which took out my stop because I didn't follow this rule here, right? So it is good to go for this point here, and then you decide 2.2 is not good for you, then you delete the trade, you have no trade. But if it's a good risk reward ratio for you, then you go for the trade. You don't decide to set a high RR before because you want a high RR. You set your RR based on what the trade is offering. Stop loss goes to where stop loss is supposed to go to, right? So let me give you an example of a trade I got taken out. Those of you on Twitter, I just said share this trade. I actually shared this trade NZD USD. So with NZD USD, I took this trade on the 20 minutes. So it's a very similar situation to what AUD card is doing now. So price broke this level here that I was looking at. It was actually a long-term trade. I took this sell here. So when price came back to this region and rejected, I went back into the trade here, right? So yesterday when I took this trade, this was a good stop loss because the stop loss was not above here. The stop loss went above the next high here, which for that trade at this point here was a good stop loss. But looking at this current rate from this level here, your stop loss is supposed to go to the next high, which is above this region here. And that is an example of what price did here. Price came up, took this stop loss region. But ideally, if the stop loss is here, you'll still be protected because the market would always have a protected high, which means there are certain high regions like this point, which will serve as a swing point that the market would not take out unless it's looking to seek like extreme liquidity. So most of the time, those highs will be protected. Your current high is not the one that gets protected. Most of the time, that high serves as liquidity, and that's what price they took out liquidity and push it. So if you didn't take this and hit stop loss, this is a good trade that you can look to get into, right? But at this point here, you now have to determine where your target is going to be. So the basic simple way I look for my target is to go from here to here, move this to the next high here, which will be this. So this will be your first immediate target. So your risk reward on this trade is what? 1.51. So you ask yourself, are you willing to take a 1.51 risk reward ratio? And if you don't want to take a 1.51 risk reward ratio, you don't take the trade. If it is something that makes sense to you, you take it. But this is the basic. We are currently on the 20 minutes. You could get like a higher target based on where this trade could potentially go to. So if you're looking at this on the 4 hours, so the extreme TP here would be a weak fill here, which on the 4 hour you can see it's a very good rejection of this level here. Price came, created this level here. So this is currently a very good sell. So looking at this from this time frame perspective, if I'm looking for a target on this trade, what would I do? So currently, if you look at a Dixie, right, we are looking at a pullback on the Dixie to the upside. Like that is a potential pullback. So we need more like confirmation, right? It looks like it's going to continue. So this is based on how price is setting up on the 11 hours. We see extreme rejection here, creating a liquidity here. And on the 13 hours, no, not on the 13. Where did I find this zone here? Hold on. All right, so this actually looks like price is looking to come back into this extreme level here. But if I'm trading the dollar, I'll look to get out of here, which means I don't trade the Dixie, but I'll use it as a guide to get out of my USD trade when the Dixie gets here. This is also a critical point to look at, which means price can reject here. But with that being said, that is why I'll be looking for strong USD. And on the 16 hours or the higher time frame, even on a daily time frame, you see that this is extreme rejection to the downside. So, but long term, if you're looking like we take out the low and long term prices going down, what you would look to do, which is an extreme. The reason why I was avoiding that is we need like a big push on the Dixie for this to happen, right? And that gives like a long term projected target of about 1:3.14 ratio. But I would just go for the weak fill and see how the market runs down to this point here. So this is just a little bit short insight on stop loss placement. Like you don't decide where you want to put the stop loss, you put your stop loss at a protected level. And in that case, the market only takes you out when you are totally wrong, not put it at a level like you can put it here and you significantly reduce your RR, right? To 1 point. In this case, it doesn't really increase that much, but there are some situation where, like what we saw in a UD card, where your RR goes from like 1:2 to 1:4, which is significant. But if you want to have safe trades where you don't get taken out of the market when the market is actually good, then you stick to going for, like, you don't have to make it complicated. Just don't go for the next immediate high. Go for the high before the current high where prices, right? And with that, you're most likely going to be protected, and the market would only take you out when the trade is a bad trade. So this is just a short session, and I hope you learned something. Leave a comment below.